Hey, what's up, everybody? It's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and we already handled the quick just want to know what time it is version yesterday. So today we're going to be skipping all the small talk and we're going to go right into all the moving parts. And right now, well, there's a lot of moving parts. So here's what you're going to learn in today's video. Why oil prices in the Strait of Hormuz matter so much to mortgage rates. Why the Fed is suddenly talking about possible rate hikes instead of cuts. Why mortgage-backed securities and the 10-year Treasury are under so much pressure. Why builders are still offering incentives even though inventory remains tight. And why the people that are actually winning in this market, they're usually the ones that are preparing early instead of trying to perfectly time headlines. So let's go ahead and build the clock. Well, over the weekend, President Trump told Iran they needed to act quickly or there was going to be nothing left. Then yesterday, he said the U.S. held off on an attack after several Gulf countries' leaders requested a pause because serious negotiations were supposedly taking place. Now, the reported goal of the deal would be acceptable to the U.S., including Iran not having nuclear weapons. But here's the problem. At this point, these types of statements, well, they've got limited credibility. We've heard similar comments before without any kind of finalized agreement, and Iran, well, they've not exactly looked fully committed to crossing the finish line on any kind of a deal. So, yes, this may be a positive development, but the bond market's not exactly throwing confetti yet. Oil prices are higher, with WTI trading near $109 per barrel. And WTI, or West Texas Intermediate, it's actually one of the main benchmarks of U.S. oil prices, and it's closely watched because rising oil prices, they can quickly feed inflation throughout the economy. Now, stocks are lower, mortgage bonds are down sharply to start the day, and the 10-year Treasury yield, well, it's now trading above 4.65, and that's a big deal. Now, yesterday, we talked about the 10-year breaking above that 4.588 Fibonacci level, and that triggered an alert to lock from MBS Highway. Now, we've broken above 4.627, and the next major ceiling, it's closer to 4.8. The translation here? Well, treasuries have got plenty of room to rise before hitting any meaningful level of resistance, and mortgage bond prices, they've still got plenty of room to get worse before they find the next major level of support. And that's why we're continuing to have a locking stance yet again today. Now, the market, it's actually dealing with three major problems at the same time. We've got inflation risk, energy risk, and, well, credibility risk. Inflation, it was already running hotter than the market wanted. CPI, which stands for Consumer Price Index and measures inflation at the consumer level, it came in higher. And PPI, or the Producer Price Index, it measures inflation at the wholesale level and production level before it actually reaches the consumer. It also came in hot. And food, gas, and energy, well, they were all a major part of that increase. Then you add oil near $109 a barrel, which were under $70 a barrel pre-Iran war. Well, that matters because oil's not just the price you see at the pump. Oil affects transportation, transportation affects food, food affects consumer prices. Consumer prices affect inflation expectations, and inflation expectations, they affect bond yields. Now, that's why the geopolitical risk in the Strait of Hormuz matters so much. This isn't just a foreign policy story. This isn't just a consumer goods story. It's also a mortgage rate story. Now, if the Strait of Hormuz remains disrupted or oil stays elevated, inflation pressure can spread throughout the entire economy and quickly. Some feel that we've not even seen the real impact of oil prices yet. And that puts the incoming Fed chair, Kevin Warsh, in a really difficult position. Now, Warsh is expected to be sworn in on Friday, and he's walking into a really tough environment. The market may want rate cuts, borrowers may want rate cuts, real estate agents may want rate cuts, and lenders definitely want rate cuts. But the bond market needs to believe the Fed's serious about inflation. So Warsh probably can't come in sounding any kind of soft. He likely can't even hint strongly at any kind of cuts later this year. In fact, he may need to remove some of the easing bias from the Fed's statement and at least threaten the possibility of hiking rates if inflation gets out of hand. Yep, I just said it. Now, there's now talks of a Fed rate hike instead of a cut. Now, ironically, that kind of tough talk, it could actually help mortgage rates. Why? Well, because if the market believes that the Fed's serious about inflation, bond investors may feel more comfortable buying bonds again. More bond buying usually helps Treasury yields move lower, and lower yields can move mortgage rates. So sometimes the market actually improves when the Fed sounds tougher. And yeah, that sounds backwards. Welcome to bond market logic. It's kind of like regular logic, only with a little bit more coffee and a lot more emotional damage. Now, let's go ahead and shift to mortgage backed securities and treasuries for a second because this relationship really matters as well. Now, mortgage backed securities, or MBS for short, they're bonds that are made up of bundles of home loans, and they trade very closely to the 10-year Treasury because investors compare the return and risk between the two. Now, when Treasury yields rise sharply, mortgage bond prices usually fall. And that typically pushes mortgage rates higher because when the price of a bond goes down, mortgage rates go up. And that's why we watch the 10-year Treasury yield so closely, even though it's not a mortgage rate itself. It acts like a pressure gauge for the broader bond market. And right now, that pressure gauge, it's flashing warning signs. Now, let's go ahead and shift to housing for a minute. The higher rate environment and rising home values, they have created a major lock-in effect. A lot of homeowners would like to move, but they're sitting on lower mortgage rates from a few years ago. So even if they want a different home, they look at today's payment and say, nope, I think I just fell in love with my house, or at least my payment. And that limits inventory. But there's another piece to this that just doesn't get talked about enough, and that's capital gains tax rules. Now, right now, homeowners who've lived in their home for at least 2 of the last 5 years, they can exclude up to $250,000 in capital gains if they're filing single, or $500,000 if they're married filing jointly. That sounds like a lot, but those limits, they haven't been updated since 1997. Now, home values, they've increased by more than 3.5 times since then. So, for many long-term homeowners, especially in the higher appreciation markets, selling, it can create a tax problem. Now, it's estimated that roughly 15% of homeowners have gains above that current threshold, and that matters. Because if somebody's got a low mortgage rate and a potential capital gains tax issue, they're probably going to decide not to sell, and that keeps inventory even tighter. Now, that keeps move-up buyers stuck. It keeps first-time home buyers competing for fewer homes, and that keeps the housing market from functioning as smoothly as it should. And there's also proposals like the More Homes on the Market Act that would double the capital gains exclusion and then index them to inflation. Now, if something like that passes, it could help reduce the lock-in effect and bring more homes to the market, and that would definitely be a good thing for housing. Now, speaking of housing, the National Association of Home Builders, they released their Builder Confidence Report for May, and the good news is it was better than expected. Now, the index rose from 34 to 37. Current sales rose 3 points to 40. Future sales rose 3 points to 45. Buyer traffic rose 3 points to 25. So yes, those numbers improved, but let's not throw a parade just yet because all those readings are still below 50, which means builder sentiment, it's still in contraction. Now, builders are more optimistic than they were last month, but they're still operating in a difficult affordability environment. And you can actually see that in the incentives. 32% of builders actually cut prices in May, and that's down from 36%, which is a small improvement, but the average price reduction rose from 5% to 6%. And 61% of those builders are still using sales incentives. So, what does all this tell us? Well, builders, they're still trying to move inventory, and they're still trying to help buyers overcome affordability issues. And it's still one of the best places to find concessions, rate buy downs, closing cost help, and payment strategy. Now, for buyers, that really matters. The resale market may still be tight in many areas, but builders are often more willing to negotiate because they've got business models that actually depend on moving that inventory. Now, let's go ahead and bring this back to the technical picture. Mortgage bonds, they're moving sharply lower. They actually broke significantly beneath the 50% Fibonacci level, and now they've got more room to fall until reaching the 98.99. Now, the 10-year Treasury, it broke above that resistance at 4.627, and the next strong ceiling, we don't get there until around 4.8. Now, that means that the market's still under pressure, and until we see either cooling oil prices, a credible peace deal, softer inflation, or buyers stepping back into the bond market, we need to respect this downside risk. So here's the practical takeaway. If you're closing soon, and I'd say within the next 2 weeks, maybe even up to 30 days, it's not the kind of market where you want to get cute with floating that rate. Could rates improve if a real peace deal develops and oil drops? Absolutely. But could rates worsen if negotiations fall apart, bombs start dropping again, oil spikes again, or the 10-year keeps climbing towards 4.8? Also, absolutely. Now, that is literally why we continue to lean towards locking for short term closings. Now, for buyers who aren't under contract yet, this is where strategy really matters. You don't panic, you prepare. You review your credit, you review debt ratios, you review assets, you compare loan structures. You look at seller credits, you look at builder incentives, you consider temporary buy downs versus permanent rate buy downs, and you build a plan before you're emotionally attached to a house because in this market, the people who win aren't usually the people that are trying to time everything perfectly. They're the people who find a certified mortgage advisor and work together so they're prepared when the opportunity shows up. So the bottom line, inflation pressure's back in focus. Oil, it's a major wild card. Political headlines are driving a lot of this volatility. Kevin Warsh, he's walking into a very difficult Fed environment. Builder confidence improved, but it's still weak, and the technical picture for mortgage bonds and the 10-year Treasury still says we need to be cautious. So for now, locking remains the safer stance for short-term closings. And for everybody else, look at the data. Don't let fear mongers mess with your emotions and build a strategy before the market forces you to react. Now, as always, if you've got questions about buying, refinancing, VA loans, FHA, conventional financing, or how the market impacts your specific situation, my team and I are always glad to help. And make sure you check out the Shoemaker Loan Team on Facebook daily so you can be alerted to rate lock updates in real time. Now, don't forget, if you're military, law enforcement, or a firefighter, we've got your back. Through the Home Foundation, we've actually got special programs and people in place that'll serve you the way that you've served our country and our community. I'm Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage. Thanks for watching, and I'll see you next Tuesday.